Hello everyone. In this session, let's look at alpha and what is the role that is played by alpha in the investment management process. So, a few important points as a part of this session I want to talk about. We have something called low risk anomaly. So, we talk about low risky security means less returns, high risk, high expected return. So there is something anomaly to this statement. We want to talk about that anomaly per se. Then in this context we will also look at important definitions, calculations leading to alpha and the benchmark, different kinds of benchmarks that we can set to measure alpha. Once we have determined the alpha, I need to know whether it is good or bad. So trying to have some kind of benchmarks for this alpha. What are the different benchmarks that can be set for the measurement of alpha? That's one point that we are going to look at here. And in this entire process, we need to have a good understanding of the fundamental law of active management, Granades Fundamental Law of Active Management. So we want to look at that, trying to understand what it is, what are the various concepts that are covered as a part of fundamental law of active management. Then we will bring in factor regression into picture, understand the model, and there are a few factor exposures which keep changing with time, which are more and more dynamic. The investment related factors, style related factors. So we are going to do a style analysis in this context. And how do I, till here, the alpha that we have been measuring is more for linear strategies like stocks, etc. But in case I am looking at non-linear strategies like options or hedge funds, etc., how do I measure the alpha for them? So that's one more understanding that we are going to have. Then two important anomalies that are cropping up which we really need to understand, one relating to the volatility and the other one relating to the beta. So we'll talk about those anomalies as well. And to explain the risk anomaly, we have different kinds of explanations. We will try to see how we can explain the risk anomaly that is coming up. Alright, so let's get into the session. So, understanding the low risk anomaly of asset return. We know that if the risk of a security is lesser, I can expect a low return on it. Even if you recollect your CAPM model, RF plus beta times RM minus RF. So the lesser the beta is, the lesser I can expect the return on that security. But in reality now what we are seeing is, historically, those stocks which had low risk based on the past volatility. So I am taking the standard deviation or some kind of volatility measure on the past data, or I can go with the past beta, whatever is the measure. So the lower the risk means it could be lower overall risk measured by standard deviation, or lower beta, which is the market specific risk, market risk associated with the security. Historically, it has been found that those stocks which had low risk, they were having a higher returns compared to the stocks which had high risk in the past. So that is actually violating our CAPM model, because CAPM model simply said the higher the risk is, the higher should be the expected return, and vice versa. But historically this has been observed in the market. So it is going contrary to CAPM, and the study that has been conducted to understand this has actually used the Russell 1000 as the benchmark. But one thing that has been observed when people have made this statement was the tracking error was much higher, which means the deviance from the benchmark. When you talk about tracking error, we are talking about the risk of the portfolio or the security, the return of the portfolio or security minus the return on the benchmark divided by the standard deviation of the differences. So the standard deviation of the differences is mostly called as the tracking error. So it has been found that the tracking error was much higher when this particular benchmark of Russell 1000 has been used. But otherwise it has been found that those securities which were having a lesser risk overall, they had given higher returns compared to those stocks which had high risk. Similarly, the beta also has been much lower, which means this, which is otherwise called as information ratio, which is measured as the difference between the portfolio return and the benchmark return divided by the tracking error, was much higher. Especially for, this is what I am calling for low risky securities. For low risky securities, the information ratio went much higher, which means those are the ones that are much more preferable for investment compared to the ones that were having a high information ratio. Some of the important definitions and calculations we need to be aware of in this context. Whenever we use the word alpha, we are talking about average return in excess of a benchmark. So the return on the security or the portfolio minus the return on the benchmark is what we are calling as alpha. Otherwise we also call it as active return. Now here the major assumption is the benchmark is passive, which means the composition of the benchmark does not keep changing dynamically. The composition of the securities in the benchmark is more or less passive. Only once in a while the composition of the benchmark is going to change. It's not active. So I don't need any kind of particular investment knowledge to replicate the benchmark. So that is what we are calling as the benchmark, and corresponding to that benchmark, any portfolio or a security generating a higher return is what is being called as alpha. So this alpha can be produced by those kind of portfolio managers who are taking more risk. More risk that is taken by the portfolio manager, the more could be the deviance from the benchmark, so the higher could be the value of alpha. So if I really have to generate a high positive alpha, I have to take more and more higher risk compared to that of the benchmark. Similarly, another important definition. So here the objective of every portfolio manager is to generate as high alpha as possible, but without taking too much of abnormal risk. So in this context, another important definition comes into picture, the tracking error, which is nothing but it is the standard deviation of the differences from the benchmark. The excess return, if I take the standard deviation of the excess returns, so this is where we are talking of what is the level of risk that has been taken by the portfolio manager from the benchmark, how much he has deviated from the benchmark. So what kind of returns that the manager has generated with respect to the benchmark, how close is he to the benchmark or how far is he from away from the benchmark. So in many cases there are some kind of constraints that are imposed on the portfolio manager. The tracking error related constraint, your tracking error should not cross this particular number. So there are so many in the process of setting targets to the portfolio managers, the tracking error related constraints are being set, so that it ensures that the portfolio manager is not going too much away from the benchmark that has been set for him. So if at all the tracking error is much higher, if the benchmark that has been set as a tracking error for a particular manager is higher, means I am giving more and more freedom to him to experiment, to take risk as a part of the investment strategies that he is following. So the higher is the value of the tracking error, it means that I am giving more and more freedom to the portfolio manager. So the ratio of these two things is what we are calling as information ratio, which is working out as the return of the portfolio minus the return on the benchmark divided by the standard deviation of these excess return. This is what we are calling as information ratio. So this is average excess return and this is unit excess risk. So per unit risk that a portfolio manager is taking, what is the average excess return that he has generated? The formula is more or less similar to that of Sharpe ratio, because in Sharpe ratio also, if you look at, we talk about the return on the portfolio, but here we take risk-free rate of return, and here we are considering the standard deviation of the return on the portfolio minus the risk-free rate of return, which is nothing but your sigma out here. So if the benchmark is being set as a risk-free rate of return, this formula actually becomes a Sharpe ratio formula. So information ratio will be more or less similar to that of a Sharpe ratio when the benchmark is the risk-free rate of return itself. So that's the kind of understanding that is expected. Then, now that I have identified what my alpha is, the return on the portfolio minus risk-free rate of return, now I need to have a benchmark to measure it. So against what benchmark I am measuring this excess return? So some of the important characteristics of that benchmark are: one, it should be well defined. So there should be an independent index provider for the benchmark. It should be tradable. So it's not something that is computed in the air. I need to have some kind of a benchmark which is tradable. So if I am setting Nifty as a benchmark or some index as a benchmark, that index need to be tradable in some form or the other. It's not a static kind of stuff. So otherwise, whatever the alphas that I am computing, they become more and more theoretical. They don't become practical, implementable return. So that's where we ensure whatever the value that we are setting as a benchmark, it should be tradable. It should be a realistic number. It should be a low cost alternative. Like I should not spend heavily to measure my portfolio performance against the benchmark, or to compute the returns of the benchmark. It should not be a stressful exercise or a tedious exercise. It should be a low cost alternative. And it should be completely replicable. I want to use some other stocks or some other assets to recreate the benchmark. I should be individually able to buy or sell the assets so that the overall benchmark can be replicated. Because only in that case I can quite comfortably measure what is the value that the portfolio manager has added. Because if I cannot replicate the benchmark, I cannot explain the deviation from the benchmark that has been obtained by the portfolio manager. So we expect whatever is the benchmark that we are setting, it should be replicable. The asset owner as well as the fund manager, both of them should be able to replicate the benchmark. In some cases, it may not be that easy for the asset owner to replicate the benchmark, but at least the portfolio manager should be able to replicate the benchmark quite comfortably, because that is what we'll talk about. What is the value that has been added by the portfolio manager? Unless I am able to compare it with some tradable benchmark, I cannot really measure what is the success level of this manager. So it should be adjusted for risk. The higher is, so it should be a risk adjusted alpha. So there should be all the adjustment need to be done for all kinds of dynamic factors, because value factor, growth factor, momentum, all these things will result in different levels of alpha. So when we are comparing between the various portfolio managers, all set of adjustments need to be done to finally understand the final alpha after all the adjustments are being performed for various dynamic factors like value, growth, momentum, volatility, and various other risks that are planned to come up. So the objective of the portfolio manager is to create the alpha in comparison with the benchmark. So he has to deviate from the benchmark, and that deviation should be adjusted for the risk, because depending on the kind of strategy that the portfolio manager is following, the risk will be determined accordingly. So the alpha that is getting generated should be more and more adjusted in proportion to the risk that is being taken. Now that we know what is the benchmark that needs to be set, or what are the kind of characteristics of the benchmark that need to be set to measure alpha, we should be ensuring that whatever we are choosing as a benchmark is well defined, tradable, replicable, low cost, should be adjusted for risk. So now coming to very important aspect of active portfolio management, wherein we are bringing in the Granades Fundamental Law. So here it talks about the maximum information ratio. We have already said the information ratio is the excess return over the benchmark divided by the standard deviation of the excess return. This is what we call as the information ratio. What the Granades Fundamental Law says is the maximum information ratio that is attainable is equal to the product of information coefficient. See, basically manager is giving some kind of a forecast that this particular stock will go up by this much, go down by this much. So he is giving a forecast for the next few periods vis-a-vis the actual return. I am trying to measure to what extent the manager has forecasted versus what is the actual return. That correlation is what we are calling as the information coefficient. So if a particular manager's information coefficient is much higher, obviously he is able to generate much high risk adjusted return. So that's one important thing. What is the level of forecasting accuracy? This is the measure of forecasting accuracy of the portfolio manager. So to what extent he is able to forecast something closer to reality. So the higher is the value of IC, we see the higher the value of information ratio that is attainable as well. And BR, it's a multiplication of square root of BR. BR talks about the bets of the strategy. So if he has made just one bet, obviously either he may win or he may not win. But if he has made multiple bets by a number of securities that he has really traded on, and even how frequently they can be traded. So the higher is the bet, the higher could be the information ratio that he can really get through. So that is what is the Granades Fundamental Law saying. The maximum information ratio that can be attained is the product of the information coefficient, which is a measure of the forecasting accuracy of the portfolio manager, and the square root of the number of trades that he has betted on. So it's always better to play more and more often, more number of trades, so increase the breadth, the BR, and if the correlation between the manager's forecasts and the actuals is higher, overall the information ratio also is going to be higher. Here it is a big assumption that is being made in the process, saying that whatever the forecast that the manager is making, there is no relationship between the forecasts, they are independent of each other, and the information coefficient of that particular manager, the way he has forecasted the correlation with the actuals, we are assuming that across the time this accuracy is constant, but in the real world it has to be challenged, because in good times the forecasting accuracy could be much higher, but when the economy is not doing so well, the forecasting accuracy could be at stake. So it says that across all BRs, so even if we are talking about one single security for one single period versus n securities for n periods, it assumes that the information coefficient of that particular manager is constant, which cannot be, which is far away from the reality. And coming to the limitations, so it is purely derived from the mean variance utility itself. So all those that are applicable to the mean variance utility based projection, all those limitations do apply even to this Granades Fundamental Law. So even it does not contain the downward risk. To what extent? Because we are talking about how the information ratio is going to be higher. So it does not talk about the downward risk in the process, and even the higher moment risk also is not being considered. And if you look at the size wise, the total assets under management is increasing. It cannot, in reality also you could see that the correlation might keep going down as the size is increasing. More and more assets under management value is increasing. The forecasting accuracy of the portfolio manager may not remain stable. It will typically diminish. So that is not considered as a part of the model, which has to be taken into consideration. And we talked about the independence. It is very, very difficult to have independent forecasts, right? So because most of the times their bets are very, very correlated. The decision that the manager has taken will be very much correlated. So it cannot increase the BR, because the BR is increasing under the assumption that the bets are independent, but to that extent the bets are not going to be independent overall. So these are some of the important limitations with the Granades Fundamental Law of Active Management. Now, talking about the factor regression in this process, we know CAPM formula. The expected return on the security I is nothing but risk-free rate of return plus beta times expected return on the market minus the risk-free rate of return. Taking it to this side, it says expected rate of return on the security minus RF, which is expected excess return, is equal to beta times expected market excess return. So it's a combination of risk-free asset and the market. So these are the two things. So now, if I'm talking about the alpha, which is the excess return of any asset, it is the return that is generated in excess of the T-bills in the market portfolio. It's a kind of product of beta times the excess return that is generated over and above the risk-free rate of return, which is the T-bills in the long-term market portfolio. So if I am looking at going with the factor regression model. If I have to generate that, I am taking the returns of the security for each period. The risk-free rate of return also, instead of taking it as a constant for the whole period, we are trying to find out the RF at those different points in time. So if this is a monthly data that I have taken, I am taking the monthly returns of the security minus the monthly returns associated with the risk-free rate of return. How is the risk-free rate of return changing? And we are doing a regression. This is what we are taking as the dependent variable, the excess return over that period's corresponding risk-free rate of return. Similarly, I am taking market return over the risk-free rate of return for that period. So we are fitting a regression model, right? This is the independent variable. This is the dependent variable. Alpha and beta are the coefficients, the parameters which we will be determining, and this is the error associated with each of the period. And if the alpha that is generated using the market portfolio as a benchmark, if this is what is the market portfolio, and the alpha that is getting generated using the market portfolio as a benchmark, that alpha is called as a Jensen's alpha. And Jensen alpha is one of the important measures of the efficiency of the portfolio manager. Similarly, we also have a pharma French benchmark, where we are talking about the excess return on the security. This is a multiple regression model. We are talking about the market returns minus the risk-free rate of return at that particular point, and beta is the coefficient. Similarly, for each period, we are talking about the difference between the small returns minus the big returns, and with that having S as the coefficient for the same. Similarly, high minus low. Again, for each period we are considering the high minus low returns, and H being the coefficient for the same. So this is what we are calling as a pharma French benchmark. And pharma French benchmark, if it includes even the momentum as one more additional factor, it becomes a up minus down kind of a trend in the momentum. So the difference between those companies which are going up, the momentum versus the returns of those companies which are going down, and U is the parameter that is associated with that. So we have different kinds of benchmarks which we can use for producing the alpha or return that is expected out of the portfolio, to what extent it is over and above the benchmarks. Now, the next dimension that we are looking at here is finding out the factor exposures which are varying with time. Means last period, the last to last period, we are talking about different time periods and how the factor exposure keeps changing over time. Right, the factor exposure is not constant. That so during a recession, the exposure could be different. During expansionary phase of the economy, the exposure could be different. So this kind of analysis is what we are calling as style analysis. And when we use the style analysis, the fund that we are working with, the replication of the fund typically happens by investing passively in the tradable low cost index fund. So look at the formula out here. I am talking about the return at time period t plus 1. But if you look at it, we are using the beta at time t multiplied by SPY at time t plus 1. Similarly, we are talking about the value at time t plus 1, multiplying it with another beta. So betas are all coefficient. Growth at time t plus 1. And base, so these are all different kinds of styles. And we have segregated the betas, which are the weights across the value, the growth and the original, in such a way that they sum up to 1. So in the factor benchmark, we are using actual tradable funds, and the way the weights are taken are in such a way that they sum up to 1 and each one is positive. If I am looking at the return of the fund over the next period, which is the t plus 1, I'm simply looking at the replicating portfolio that I have created at the beginning of the period, and to what extent it is in excess, the return is in excess of the replicated portfolio that we have constructed during that particular period. So that is how we are considering the return of the fund over the next period. Now here we did not include the shorting at all, because we have taken all the weights to be positive and sum to 1. So there is no question of shorting included here. But if I am also considering shorting, then there is no such restriction of each one being positive. Right, we are only talking about the excess return for each of the period. We have considered to what extent each of the, for the value, the growth, all these returns are above the risk-free rate of return. The market return, the value stocks return, growth stocks return, to what extent it is above the risk-free rate of return. So that is how we are not putting any constraints in terms of what should be the coefficients of beta. We are not talking of they should be positive only, something like that. But what has been observed is, even if shorting is allowed, it did not change the cumulative excess return. So this value did not change much, but overall alpha has really gone down. And it's very, very difficult to detect the statistical significance with constant portfolio benchmarks. And in this case, we will see that the time varying styles, they will have very, very large standard errors. So which means doing the predictions with these kind of methods could be much a difficult scenario. Now coming to nonlinear strategies. Majority till now, whatever the alphas that we have computed is in a linear framework, where we talked about typically the stocks and bonds, where the growth in the change in the prices is more and more linear. But if I am working with dynamic option strategies, which are like non-linears, the alpha could become more and more misleading. I cannot capture any kind of a non-linear trading strategy to really compute the alpha in the same manner. Especially when we talk about hedge fund strategies, merger arbitrages kind of hedge fund strategy, pairs trading strategies, all these things, they are all non-linear. So in these cases, the alpha is much more problematic. It's because the overall distribution of the returns is no more close to normal. It's a heavily skewed kind of distribution. And it is said that wherever we are using standard deviation, it becomes more and more appropriate to use standard deviation as a measure when the data is decently close to normal. So when you are talking about measures like alpha, information ratio, Sharpe ratio, etc., they become more and more appropriate when we are working with the data which is very close to normally distributed. But if it is very much deviating from the normal, just like your hedge fund strategies, hedge fund returns, etc., then I cannot use the direct measure of alpha, because heavily skewed data and even the kurtoses and other higher moments, if they are much higher, the regular alpha does not take those things into consideration at all. So that's the reason the regular alpha cannot be used for measuring the alphas for nonlinear strategy. So I have to include the nonlinear factors which are tradable. That is where I am using the volatility risk factors. And when I'm controlling for all these non-linear factors, obviously there will be having a much impact on the alphas of the hedge funds. So basically I have to examine the non-tradable non-linearities through this kind of a formula, where I am considering the returns minus the risk-free rate of return, but I am also considering the various different higher order moments in the process. So this is where if I have to compute the alpha for a non-linear strategy, the same procedure cannot be implemented. I have to change the process just like the formula that I have highlighted below. Then the next topic that we are discussing here is the volatility anomaly versus the beta anomaly, just like the low risk anomaly that we have discussed in the beginning. There is a volatility anomaly and a beta anomaly. So volatility anomaly says that volatility is negatively related to future return. So the lesser is the volatility, the higher is the expected future return. So this is again a violation of our regular concept, which says the higher the risk, higher is the expected return. But this is going completely the opposite. The lower the volatility, the higher is the expected future return. And same way beta also, the realized beta, the historical beta is again negatively related to future return. That has been the observation from the historical data. So when we are talking about risk adjusted performance, it is dependent on risk. So if the risk is lower, the risk adjusted performance is expected to be higher, and vice versa. The lower the risk adjusted performance is expected to be higher. The higher the risk adjusted performance is expected to be lower, and this difference is very highly significant. So the stock portfolios with much lesser variance in monthly returns, whose variance is much lesser, they were producing a higher returns compared to those stocks which are much highly risky in the past. So that is what we are talking about, volatility anomaly. So that is what, if you see, the returns of high volatile stocks were very low. That's the historical experience. So we are going completely contradicting our CAPM model altogether, right? CAPM and various other multi-factor extensions, they completely highlight the other way. The higher the return comes from, the higher the risk that is associated with that particular security. And the CAPM and various other multi-factor models, they highlight that the volatility itself should not matter. But this is how we have observed the returns based on the volatility. Especially the markets where there is a lot of segmentation because of clientele effects. The idiosyncratic volatility, which is more and more of individual investors specific volatility, that is positively related to the return. So if some individual with more knowledge of information or no knowledge of information or little knowledge of information, that is what is contributing to the clientele effect. When clientele effect is very high, that individual specific risks that are being taken, they are resulting in higher positive expected returns. So there are so many noise traders, sometimes rational, sometimes irrational, they just keep trading. So they don't even do a fundamental valuation of the security or anything. They keep buying and selling, which is where maybe rational, maybe irrational. So they do the trading for random reasons. So in those cases, if the volatilities are higher, it is very much understood that they may result in higher risk premiums as well. And what is being typically looked at is the idiosyncratic as well as the total volatilities. It has been overall observed that they have a negative relationship with the returns. So the higher is the volatility, it has been observed that the lower is the overall return and vice versa. Most volatile stocks which are currently losing money, it is said that they keep losing, they will be keeping on losing the same in the future as well, because the volatility is much higher, people don't want to invest in them, so they keep losing out their value even in the future as well. So this is the big anomaly which is going against the traditional strategies like CAPM, etc. On the same lines, if I talk about the beta anomaly, beta shows no power to explain average returns. And it has been observed that the relation is a purely negative relation. So again, beta is also a measure of risk. The higher the risk, the lower is the returns and vice versa. That is what the data has been explaining from the historicals. So the stocks that were having high betas, they had lower risk adjusted returns. So the higher is the volatility, they had lower risk adjusted returns, and because of that their Sharpe ratio RP minus RF by sigma is higher but this is lesser, which means overall Sharpe ratio also has gone much lesser. So contemporaneous relationship is existing. Typically the stocks which were having high beta should have higher average returns, but what is typically looked at from the historical is the other side. But again, if I have to continue the same, there is a lot of difficulty in predicting the future betas, especially for those non-linear derivative securities based on the past beta. So, but the anomalies are very, very important for us to understand, because sometimes we are of the notion that higher the risk that we are taking, the higher is the expected return. Now, what are the potential explanations for risk anomaly? In the data, it has been very clearly observed that the risk anomaly was existing, the low risk resulting in higher returns and vice versa. So some of the explanations that were provided were, one, it could be a data mining scenario. So some sensitivity in the results to different portfolio weighting schemes. Because of that, we got low risk resulting in higher returns and vice versa. Or it could be because of various illiquidity effects. So the low risk effect, it appears very significantly during recessions and expansion, and during the volatile and during the stable period or volatile period, or it can be existing even in the option market or commodities, which means this low risk effect has been observed in almost all kinds of economic scenarios, all kinds of volatility markets, and even with across all kinds of instruments. So there is one way to talk about it, could be a data mining bias, but again that needs to be really evaluated. Then the other possible explanation for the risk anomaly is a leverage constraint. Investors wish to take one or more risks, but they are constrained with the amount of leverage that they can take. So they are willing to take the risk, but they can't take the leverage. Higher the risk that they are taking, the higher could be the leverage, and they have a constraint with respect to the amount of leverage that they can typically take. They cannot borrow, so which means they are holding the stocks with built-in leverage. They have high beta stocks with them. And because of that reason, the more and more high beta stocks that they are having, and they have constraints on the leverage, the SML is getting, the security market line is getting more flattened. So that's the reason the underpricing of the low beta stocks relative to the market is happening, but this model does not take into consideration why the low beta stocks are relatively underpriced. It is only talking about high beta stocks are going more and more overpriced. That is the only thing that has been taken as a part of the study, but at the same time they have found that those stocks which had low beta, they were underpriced, but this model did not give any kind of an explanation for that particular aspect. leverage constrained institutions should actually be attracted to high risk stocks because they have a lot of leverage constraints. So they cannot take a leverage beyond it, but they should be attracted to high risk stocks because high risk stocks are typically tended. The high risk stocks are expected to provide higher returns, but that's one more theory that is getting challenged because if the institutions are having a leverage constraint, means they cannot take more and more borrowings. So if they are not taking more and more borrowings, they have to hold stocks with built-in leverage like high beta stocks. So that is where they are getting more and more attracted to high risk stocks. Then agency problems also could come into picture because many of the investment institutional managers that we are talking of, they cannot play the risk anomaly at all. They cannot invest only in the low risk stocks to get higher returns and vice versa. And if the asset owners simply have a preference for high volatility and high beta stocks, they keep bidding up, they keep buying these stocks until they have low returns. As simple as it. So the stocks with low volatility and low beta, they will always have low prices and higher returns for these shares compared to the ones that are having high volatility and high beta. So these are some of the potential explanations that we can talk about for the risk anomaly. These are some of the things that I wanted to cover as a part of this session. If you have any further queries, you can very well get back to me by giving me a call on the number that I have given below, or you can even send in an email at vamsidhar@basegurus.com. Thanks a lot for listening to this session. Thank you very much.